Hi, folks. Welcome back to StansberryInvestor.com. I am Daniela Cambone, and before we start today's broadcast, just want to share with you a report that Stansberry Research has put out that I highly urge you to check out, because with most investors going about life investing and retirement planning as if nothing unusual has happened to our financial system, not realizing the repercussions of the 11 trillion that's been pumped into the financial system in the past 18 months alone, it's especially a good read at this moment in time. At least 4 billionaires have stated publicly that Americans aren't paying enough attention to this development. And now a former Goldman Sachs banker says sooner than most people think, millions of Americans will potentially be pushed down out of the middle class, out of private retirement, and out of a decent life based on independence and privacy into a collectivist nightmare he calls financial lockdown. So find out how to protect yourself, your money, and your family with a free copy of his new report. In it, he'll show you the 4 steps he recommends you take immediately. So if you'd like to get a copy of this free report, you simply have to go to www.wakeupcall2021.com. Again, that's www.wakeupcall2021.com to get your free report. All right. That said, please welcome to my show today, Brent Johnson. He is the founder of Santiago Capital. He is also the creator of the dollar milkshake theory, which we will talk about again. Please welcome back, Brent. Brent, good to see you.
Happy to be here. Thanks for having me.
So it's interesting what you've come with today, saying that you're seeing inflationary forces struggling with deflationary forces. I feel like I've heard so many theories surrounding this. How do you see it, Brent? What's playing out here?
Well, yeah, I mean, I kind of feel like, for the last, call it, certainly the last 6 months and maybe even the last 12 months, there's been this big debate of what comes next. Is it inflation or deflation? And I think it's pretty clear we've seen rising prices for the last year, right? Whether it's asset prices or commodity prices, home prices. I think in my mind, the real question is what comes next and whether it's inflation and deflation. And the thing that I think is most interesting is most people I talk to are pretty set on what they think comes next. The inflationists are absolutely convinced that it's not transitory. The deflationists are absolutely convinced that it is transitory. The people in the gold community absolutely think we should be all in on gold here because this is just a financial experiment gone completely wrong. The people in the Bitcoin world think that, also the system's just gone wrong and this is the only escape hatch. And I feel like it's a time of great uncertainty, but yet everybody is so certain in what comes next. I'm not certain of anything, I'll tell you that. My highest conviction is that we're going to see a higher dollar than many people think is possible, but I'm not sure what's going to happen. And I think what we're seeing in the markets today is a good example of that battle.
So that's really interesting, and you brought up a higher dollar. Let's talk about that today, because that's really at the epicenter of the theory that put you on the map, the dollar milkshake theory. And not to simplify it too much here, but basically your theory suggests that we have a milkshake liquidity created by global central banks, and the U.S. dollar is the main ingredient in this. But as the U.S. dollar strengthens, it will have the capacity to destabilize a global financial system. So as we're speaking right now, the dollar's around the 93 mark. We see what it's doing to gold, but at what level would the dollar need to get to where we'd see it really starting to affect global financial markets?
Yeah, I think it's around 95 level where it starts to get concerning for some of the monetary authorities. If the dollar's between 85 and 95, or let's call it 90 and 95, I don't think that they care much. It's kind of noise. But if you start to break below 80 and into the 85 range, they'd probably love to see that. But if it starts to get above 95, it starts to get a little destabilizing. It starts to put pressure on the global economy because everything is priced in dollars, everything is traded in dollars, and at that level, the extension of credit starts to get a little iffy, and so the uncertainty comes in, and it kind of has this effect where it becomes self-perpetuating. A stronger dollar begets a stronger dollar, so to speak.
So how do you, or what are you doing to protect yourself if you don't know, which way the dice will tumble here on the inflation deflation camp, but you are forecasting a stronger US dollar? What are you looking to place yourself in these days?
Well, first of all, I'd say is we have cash on the sidelines, and I think everybody should have cash on the sidelines. We've had that for a year, so it does. But we've also owned equities. We've also owned some fixed income. You know, all of our clients have real estate, various forms of venture capital or private equity, and I think that's smart. I think you should kind of be prepared for everything. I think you should have a diversified portfolio. But I think you should have some hedges in place in case the dollar does get out of control to the upside. And I think you should have some cash on the sidelines to take advantage of some of the dislocations that come. Again, I don't know for sure what's going to happen. I just can't figure out how the dollar gets materially weaker and stays there. Is it possible that it goes lower in the short term? It's possible. I can't rule that out. But I don't think unless they completely redesign the system, you can ever remove the potential for a dollar spike. And considering all the bad debts that are in the world, and many of them priced in dollars, as those bad debts start to, I guess, roll through the economy, the underlying collateral, which is dollars, gets bid up. And I think it's the most underappreciated risk in the market.
Interesting. Okay. So, and when you say having cash on the sidelines, I've had guests coming on saying, well, they're not feeling comfortable having cash in the banks these days because they're saying if we do have a financial crisis, that would see banks bail in this time around, and you might not be able to have access to that cash. Is that a concern of yours, or do you think that's just nonsense?
I don't think it's nonsense. I think it's okay to have some cash in the bank, but I think you should probably have some physical cash outside of the bank that you can access that maybe get you through a couple of days or a couple of weeks in case some kind of a mass hysterical bank run or something like that, in which they shut the banks, which is not impossible. So I don't think that's foolish, but I also don't think you should be all in on that either. I don't think you should have everything out of the bank stuffed under your mattress just waiting for the sky to fall. I think people should own gold too. If we have a banking system collapse, gold may go down initially just in the liquidation phase, but then it probably gets bid up very quickly. Very similar to what we saw last March. Gold had a bad March last year, but since then, it had a really nice run. So I guess my point is, I think because it's a time of great uncertainty, I don't think you should be all in on any one trade. I think you should have a bunch of little bets made for any of these possibilities and kind of be prepared for everything. I'm a big believer in gold in the long term. I always suggest that clients own gold. I don't necessarily think gold's going to pay off right away. I think I should preface this by saying depends which currency you're in. If you're a U.S. investor and priced in dollars, I don't think it's going to pay off right away. But if you're a Turkish citizen or a Lebanese citizen or even an Australian or a Canadian citizen, it might be different. It might do a little better under in those scenarios. But again, I think you should be prepared for everything. I am on record of saying I think the deflation comes next, but I'm not all in on the deflation trade. I just don't think you can ignore it.
Right. And I want to understand that a little bit more. Your thinking there. So, okay, firstly, we talk about inflation, we talk about deflation, we talk about stagflation. Do you think the regular investor out there, Brett, has bought the inflation story yet?
I think they're starting to. Especially here's the interesting thing. I think a lot of the people who don't have the income level or the asset level to go invest are definitely feeling it. The lower and the middle class, they see it when they go to the grocery store, when they put gas in the tank, and just their general cost of living is going up. They're kind of getting squeezed. Now, the next level up, the people that have some excess cash, I don't know that it's necessarily really started impacting them yet. It's probably started to. But I do think that once you get it, I think in the investor level, that's where this big battle is. There's still a lot of people that have, still have scars from 2008. They refuse to invest in anything because they just think the collapse is coming. On the flip side, you have people that were getting the stimulus and just plowing it into Robinhood and doing day trades on tech stocks. So I think there's a battle there as well.
I mean, someone argue the Fed wanted higher inflation. They need higher inflation. They got the higher inflation. If we were to transition, as you suggest, from inflationary to then deflationary, what happens? Is it because the Fed's making that transition or they lose control?
Okay, so it's a little bit of both. And I'm glad you brought this up because I want to say, I don't think the Fed pauses anything because I think the Fed is reactionary to the market. I think if the Fed stepped away, everything would crash, right? Okay. But what they do is they're reactive. So when we had the massive downturn in March of 2020, the central banks came in and reacted to that. Now, since then, we've seen prices rise. But if you think that they are going to continue doing QE or doing more QE, then you must believe that there's massive deflation out there that they're trying to offset, because they don't front run markets. They don't want to, you know, they don't want to be the cause of the crisis, even though they typically end up being. But right now, you know, now we've seen prices rising for 12 months or 15 months, 16 months, however you want to measure it. And I think they're starting to talk about tapering. And, you know, rates have been, you know, the front end of rates have been pushing negative because you know, there's all this debt in the economy, and the market's trying to force rates negative, and the Fed has actually put a process in place to keep the short rates from going negative. So they're starting to do some programs here where they want to start winding it down. But again, I think they're behind the curve, right? I do think that they will start to taper, or at least announce the taper, but then the markets will roll over and then they will come back in. But when they come back in, it'll be a reaction to the deflationary forces.
Okay. Okay. So you're not in the camp that the Fed can never taper, because I've been hearing.
Well, I know. This is where there's nuance, right? And I think a lot of people, again, they're so in their camps that they don't allow for nuance. They can taper, but they can't normalize, right? Can they get 1 or 2 months, 6 months of tapering? Probably. But then when things really start to go south, then they would have to reverse. But again, I think they will be reactive. Right now, they're reacting to higher prices. And to your point earlier, they want higher prices. That's their goal. Their mandate was to get inflation over 2%. You know, for years and years and years, they tried to get inflation and couldn't get it. Now they've had it for 12 or 18 months. And so now they're starting to react to that because they don't want it to get to 6, 7, 8, 9%.
Well, we're speaking ahead of a lot to digest, you know, who knows how this plays out. We're speaking ahead of the Fed meeting that many are expecting to be quite hawkish. Who knows? Do you think anything massively changes after this Wednesday?
Well, I think that they are going to be relatively hawkish. I don't think they're going to come out and say we're normalizing our balance sheet and QE's in the rear view mirror.
Right.
I think it's going to be a dovish taper, for lack of a better word. I don't think they're going to announce the taper. I think they're going to announce the intention to taper. Maybe they'll say in November or December, we're going to start decreasing the size of our purchases, but it's still a net additive, right? They're still buying. It's just not at the same rate. So it's like you're going down the highway at 100 miles an hour and they say, you know what, we're going to take our foot off the gas and we're only going to go 80. You know, it's still, so it's a relative phenomenon. I think that there's a battle between the Fed and the Congress, for lack of a better word. The Fed wants to start pulling back on the QE, but they know that they need fiscal stimulus to kind of keep the economy going. And the Congress can't get out of their own way. The Democrats want this, the Republicans want to fight them. And so I think the Fed knows that they need a stimulus bill, additional stimulus. And I kind of feel like they're playing chicken with the Congress a little bit. So I think they're going to announce that they're tapering and kind of force the Congress's hand. And maybe we'll get a market correction as a result. Maybe the fourth quarter is a little volatile. It kind of puts a fire under the Congress to kind of come together and come up with some new stimulus plan. And this is the nature of my transitory arguments. You've heard me say before that I think inflation is transitory. It's not that I don't think inflation is possible. It's just that I think additional things happen for it to not be transitory. And one of the things that happens for it to not be transitory is the Congress has to come in with additional fiscal stimulus. And I think it's harder to do that than many people think. Mm-hmm. I think a lot of people just assume that the Congress is just going to spend. There's no pushback. But in fact, there is pushback. The senator from West Virginia has kind of become the most powerful senator because he's a moderate, he's in the middle, and he's kind of pushing back on the Congress's desire to spend more money because he sees inflationary pressures. And because the Congress is so evenly divided, it's not as easy just to pass what they want. And we've got the debt ceiling coming up, and the Republicans want to make the Democrats look bad, so they're going to fight it. At the end of the day, they're all going to vote for it. But there's going to be political theater involved. Everybody's going to try to score political points. And I think when those political points are scored, that's when you get these deflationary pressures show up. So I don't think you can ignore the deflation argument. Even if you think that they're going to eventually do more stimulus, I don't think you can ignore it.
No, I hear you. I hear you. And I think there'll be more theatrics this time than in the past. But Brent, really good thoughts. Final question. I'm just curious because, you spoke about, how important it is to be diversified. So if I gave you $100,000 right now with a 2-year horizon, right?
Yeah.
For you, just here's 100,000. Where would you park it? You said you like gold. Would you go on all in gold right now?
No, I think gold has already made its high for the year over the summer. But in a very general, and this is not financial advice, but in a very general sense, if you gave me $100,000, I'd buy 20,000 of gold, 20,000 of the Dow, $20,000 of fixed income, $20,000 of real estate, and I'd keep $20,000 in cash.
All right, nice. Thank you for answering that, and thank you so much. And thank you so much for joining me, Brett of Santiago Capital. Always a pleasure. Come back anytime to StansberryInvestor.com.
Thanks for having me.
And thank you so much for watching. We'll have much more for you in the meantime. Don't forget to sign up for premier content you can't get anywhere else, folks, at DanielaCambone.com. That's it for me. Thank you for watching.